Welcome to the Sanlam Insure Your Future Money Bootcamp with me, Mapalo Maku.
And me, Maya Fisher-French. To give our listeners a little bit of a background, we've been working with Sanlam staff members where we take them through a money bootcamp.
Last year, after seeing the amazing changes these individuals went through, we realized that there was an opportunity to take this money journey to a broader audience. So thank you very much to Sanlam for sponsoring this podcast.
Now, over the last few months, we have focused on accumulating wealth. But what happens when you've finally had enough of your boss, Mapalo, and you want to retire? In our case, we are our own bosses, so we can't do this. But maybe we've just had enough of working for ourselves even, and we want to retire and enjoy the fruits of our labor. So joining us today, we have Johann Steyn. He is a certified financial planner at Rainmaker Bluestar from Sanlam. And Johann has been on before, chatting to us about life cover. And as you know, Johann is working with some of our mentees who are closer to retirement. So definitely the right person to be bringing in here today, Mapalo.
No, absolutely, Maya. Now, Johann, let's say you are 5 years to retirement. What are the conversations you are having? But I know, of course, a lot of people come to you like a year before. How do you deal with that, number one? But also, what conversations do you have with someone who is 5 years away from retirement and those very other people who come to you 1 year before retirement?
Only 1 year, the day before retirement.
In panic.
Hi, Mapalu. Thank you for the opportunity. Yes, you're rightly saying that I get a lot of calls 1 month or 2 months prior to retirement, and then I don't know if I should run, hide, or what I should do. The scariest thought, typically, if someone plans just so close to retirement, is I would probably not chase them away because they might run around until they hear what they want to hear. And the biggest reality when it comes to retirement planning, if it's 1 year or 1 month or 5 years prior to retirement, is to consider the retiree or the potential person who's going to retire now, their expectations, what they understand with regards to their options, legislative options, but also the options with regards to the purchasing power of their money. So yeah, that's the biggest thing from my side, which I believe the discussion should be around expectations.
And I can imagine if I'm retiring and I haven't planned well ahead in time, I'm going to get some scary facts. How do you sort of let people down? Because you're going to have to tell them that you actually perhaps don't have enough, or this is the legislation and these are the limitations that within which you can take your pension. How do you let people down? And I mean, how have you coped with that? Seeing retirees where perhaps they don't have enough money and letting them know that, no, it's not what you think.
So it's never great to be in a position to be the bearer of bad news. So we can all agree to that. I think the one message that we give to our clients in practice is that we can't change the position that you ended up when you sit in front of us. We weren't part of your past, and there's nothing you can do about your past anyway. Yeah. So the focus should be on what's the most effective way that you can facilitate what you've got, and how can you manage that going forward, and then to realize the reality of the position that you're in. And Maya, you've mentioned someone who's tired of their boss and they want to retire. In general, and we don't want to generalize, but in general, people who retire early will have to make some form of sacrifice. So either they made sacrifices earlier to save more and invest more to be able to retire earlier, or they're going to have to sacrifice now for the rest of their life and have to be happy and satisfied with less income that they were probably used to.
Have you ever had to tell someone, let's say they are 60, that actually you can't retire, maybe go back to work for the next 5 years because right now you actually...
For sure. I'm seeing that already. I mean, even with our mentees, their expectation of what they need for retirement is totally off. You know, a lump sum looks like a lot of money, but it's not.
Yeah, a lump sum can be very conceiving, and what you can do with capital in your hand versus what that capital is worth over a lifetime if you have to split it up in monthly income payments. It's quite a big difference. But I've found nowadays that people tend to realize that a lump sum is not as much as what it looks like, but I still find a lot of people that don't realize how little it can be if you spread it over life expectancy. And coming to life expectancy, that's the other thing, is people don't realize how old they can actually or might get. They think, my mother died at 80, or my dad died at 75, and they're 60 now, so they think they're only going to live 15 years. And we see our clients living way into their 90s. And the last thing, and that's actually the most important message that we give our clients, is when we work with you, we don't necessarily work with your money. Yes, we give you advice on your money and we assist you in facilitating investments and solutions. But we're actually facilitating your dignity. And we want to protect your dignity over your lifetime. And as you get older, you get more vulnerable. And the more important that independence becomes to you. You don't want to look into someone else's eyes to provide for you.
And I think for me a really good starting point, and it's one of the things that I've already been talking to some of our mentees about, is what do you need to live in retirement? Putting together a retirement budget. That must be the most important first step. How much do you need?
So what we typically would recommend is that you take your existing budget. Most people don't have a budget, and that's a scary thing. And the reason why they don't have a budget is because they believe that the expenses are more than their income. So they're scared of what they will find when they look at the budget. Now, I usually recommend that even if your budget doesn't add up, or if you go over your budget, write it down. Just look at it. Because by just looking at your budget and looking at the deficit, you might influence your behavioral change. And I've seen that a lot of times. So people want to steer away from budget because they think they don't have enough money. So we force them to take your bank account and go and sit down and literally mark off your expenses. And let's see which of these expenses can you live without after retirement, or even now? And then which of these expenses can you not live without? And if you are 5 years prior to retirement, if you can cut some of the expenses now already, then you can prove to yourself that you don't need these expenses. And you can live off less money when you retire.
And you can put those savings
away.
Into your retirement. Yeah.
Yes.
And the importance of debt making sure debt is paid off by then?
So a lot of people work with the assumption that they'll utilize their lump sum withdrawal amount at retirement to pay off their final debt. And yes, practically it can be done. You can do that, as long as you realize whatever money you take out of your fund, even if it's that so-called 1/3 or your gratification, whatever you take out is less income for the rest of your life in your pocket. So ideally, 5 years prior to retirement, you can set up a plan to try and pay off your debt closer to retirement. And people who work, especially people who work for big corporations, they're used to getting incentive bonuses and 13th checks. Use that money to pay off your debt quicker. For instance, if you need to buy a new car, buy that car and pay it off within that last 5 years prior to retirement. Be careful for residual values, because people buy cars, they want to pay the least amount of installment, but then they've got a balloon payment at the end. That balloon payment's got to come from somewhere. So you're either going to refinance it, or you're going to take the money out of your retirement funds to pay it off.
That's a good idea, to sort of make sure your car is paid off as well by the time you get to retirement.
Yeah, and what about your bond as well? Do you want to make sure you pay off your bond?
Definitely. Your bond, even more important, or in the same principle than your car. Any large expenses, and stay away from debt. I think if you've got things like credit card debt or personal loans, the first step is to understand, where did this debt come from? Was it as a result of your monthly expenses that's more than your income, or was it because of like a once-off event that happened? If it was a once-off event, I'm usually not worried, because then you can assist a client and you can build up emergency funds for these type of events. But if you've built up your debt, clothing accounts, credit cards, all these kind of short-term lifestyle debt, that's a warning sign going into retirement. So 5 years prior to retirement, you should get into the habit of getting rid of that. And I see a lot of clients who they've got these facilities, and they keep it open because they got the facility and they don't want to use the facility. And I try and explain to them that the facility is not your money. You've got access to somebody
else's money at a
And
very
you're going to
high
pay it
price.
back with
Very high
interest.
price. So if you are scared for maybe getting a flat tire and you don't have an emergency fund, keep the facility open, but let's start building an emergency fund. That's one of the biggest shortcomings that I see in financial planning is very little people have an emergency fund because access to debt is so easy nowadays. And building that habit of having an emergency fund can deteriorate a lot of other problems.
And especially, I mean, that's an interesting one going into retirement is making sure you still have your emergency fund.
Yes.
Yeah. And now let's talk about medical expenses, because now the older you get, the more you really should have some sort of medical aid. But it's expensive, Johann. How do you start balancing, making sure that you pay off your debt, making sure that you have medical aid, for example?
Yeah, I mean, it must be the time that you need your medical aid
the most.
Yeah.
So what I experience a lot, and especially in retirement, is that people don't realize the high inflation on medical expenses. Yeah. And especially just by keeping up a medical scheme or even just a hospital plan. The average increase on a hospital plan is almost double inflation. And if you consider, let's say you earn 20 or 30,000 Rand a month, and let's say your medical scheme is costing you 3,000 Rand a month. If you earn 30,000 after tax and your medical is 3,000, it's 10% of your income. But if you consider the medical scheme inflation, 10, 15 years down the line, it won't be 10% of your budget anymore. It will be 15 or 20% of your budget. And it will get worse the older you get. So the reality need to be accepted that to maintain a medical scheme, and in my opinion, it's almost a non-negotiable. To maintain a medical scheme is going to deteriorate the rest of your lifestyle or your other lifestyle expenses. So you need to decide up front, where am I going to start saving money in the future to be able to still afford my medical scheme?
So when we looked at our retirement budget, I just doubled our costs on medical. I just doubled it. I said, well, that's the number we would need,
Yes.
to cover it. But I want to just kick off a little bit explaining to people. So I think it's very important having this conversation, understanding your budget, paying off your debt, making sure you understand what this number is. But there are all these products when you get to retirement. Oh, my goodness. Living annuities, life annuities, hybrid options. Let's just maybe start to unpack those, Johanna. And which product is appropriate when?
So I think the two main categories that people can keep in mind is you've got investment-linked solutions and you've got guaranteed solutions. So when it comes to retirement funds, the rules of the fund limits you on how much you can withdraw as a lump sum, and then there's a remaining portion. And you don't have to withdraw the full lump sum, so it limits you up to a certain point. Typically, it's 1/3 of your capital, and the two-pot system, which is a whole argument on its own.
Another whole podcast.
That's a whole podcast on its own.
We'll unpack that further, but you've got this capital amount built up in your retirement savings, and you must purchase a pension with this capital. And you can opt for various options and even combination of these options. So to unpack them, an investment option is where you would typically purchase a living annuity. A living annuity is where your money gets invested after retirement. You decide with your financial advisor on an appropriate investment portfolio. You balance the risk between return and stability of the income that you need to earn from this portfolio. And then furthermore, in a living annuity, you choose your income. And this is where it becomes very difficult, and where discipline needs to come into play. Because a living annuity allows you to withdraw per annum between 2.5% and 17.5% of your capital per annum. Okay. Now, if you consider the typical balanced portfolio will give you a return of inflation plus 4 to 5% over the long term. So we're considering a return of 9 to 10% per annum. So if you draw more than 9 or 10% per annum of your portfolio, your capital will start to deteriorate. Now, the problem is that some people think that, okay, but if my return is 9% per annum, I can draw 7% out of my living annuity, because then all my investment returns gets put back in the portfolio. The problem is they don't bring into factor that this income that they draw must increase annually with inflation to be able to keep up with the expenses. So a living annuity should be taken with a lot of care. hopefully with the assistance of a financial planner who can forecast income needs and who can forecast withdrawal rates and returns on your portfolio. The other side of purchasing a pension is to buy a guaranteed solution. A guaranteed solution is typically where a client can take their retirement money, they can go to an insurance company, and the company, they forfeit their capital. This is very important. You forfeit your capital, so you give your capital to the insurance company, and in return, the insurance company gives you a monthly income for the rest of your life. They're guaranteed for the rest of your life.
You buy an insurance.
You buy an insurance.
You buy an insurance.
Yes.
That's what it is.
And they give you that monthly income. And then you can add things like an annual increase, for instance, inflation. You can add your spouse to it. Now, everything that you add comes down to what rate you'll end up with in the end. But you can add your spouse, which means that if you pass away, your spouse will continue with the same or a percentage of the income. And you can even build in a small inheritance factor. So if you pass away very shortly after retirement, that even your beneficiaries can still get some of this capital back or some of the income back. So there's various factors. But the main important thing to realize on a guaranteed life annuity solution is for you as the pensioner, it protects you for life, for the rest of your life on your income. You cannot change that income. You cannot change the contract afterwards. You will get this income for as long as you live. Even if you live until 150 years of age, you'll get this income. So it protects you against your own discipline, but it also protects you against long-term life expectancy. And that's the biggest mistake that I see a lot of people make, is they don't realize how long they can live. They might live.
So with life annuity, what I'm getting is the one who lives the longest wins.
Yes.
Yeah, but remember,
it's a bet.
Yeah, it's a bet. But keep in mind, you as an individual are betting with the life insurance company, but you're not their only client. So let's say I'm a life insurance company. I've got 100 clients. I know 50% of my clients might live until 100 and 50% might not. Okay, I don't care which 50% is going to live, because for some of them I need to pay out, and for some I don't have to, because not everyone is going to live until age 100. So people share in the risk pool, which means the life insurance company can offer you a slightly better income than you could have given yourself if you were to bet against yourself in an investment environment.
It's quite interesting because I did an article recently on life annuity rates versus living annuity rates. So obviously living annuity, they're saying you shouldn't really draw down more than 5% per annum in order to keep up with inflation and make sure your capital doesn't run out. But the rates that you're getting with a guaranteed annuity are so high at the moment because they're linked to the bond rate.
That's correct.
So they're sitting at 11% or something, the bond rate. But that, you're getting substantially more a month from buying a guaranteed annuity right now than the living annuity drawdown of 5%. Yet people still want living annuities because of this idea that you can't leave your child an inheritance. So I think maybe unpack that aspect a little bit.
So we've done a lot of calculations for our clients. And we've even done calculations to say, listen, let's say, for instance, you draw out of a living annuity the same income that a guaranteed life annuity would give you, and with reasonable returns. How long will it take before your living annuity reach that point, that 17.5% drawdown point, where you can't withdraw more, you can't increase your income anymore with inflation, and your income is going to start to deteriorate drastically? So typically you'll see that's in a very short frame of mind. So if you opt for a living annuity, you'll have to take less income to have the money last until a reasonable life expectancy. Okay. Then what we consider, or what someone needs to consider, is what other assets do they have? So typically, if you outlive your living annuity, then the logical thing would be to sell some of your other assets. So you might sell your property, and a lot of people say, I'm going to sell my property anyway because I want to go smaller. The problem is smaller is not necessarily cheaper.
No,
Smaller
it is
nowadays
not.
You
is
know all
actually
about
more
that,
expensive.
Maya.
I know, my mom, we've just done that exercise for my mom and it was not cheaper, no.
But let's say in theory it was true. Then still you need to use up your other assets capital, like for instance your property where you live in, and you'll have to use that asset as well to live off the income. Whereas if you had a higher income, than on a living annuity, for instance, and you could live off that, then you'll still have this property which your children, for instance, can inherit. Or you can have a larger portion of that asset value that your children can inherit. So one shouldn't just assume that you'll leave money behind in a living annuity for your children. The average amount that stays in living annuities at death is less than 150,000 rand. So yes, there's a few people who die early in their retirement, but the average amount that the platforms pay out on living annuities at death is below 150,000
That is
Now
so
that
telling.
tells you something.
That is so
And
telling.
it's something I come across so often, especially with government employee pension funds members, because they are forced to buy an annuity. They don't get to have a living annuity, they get a guaranteed annuity. Now, you can choose in the retail world, you can choose to have a guaranteed period of 5 or 10 years, which means that your beneficiaries will still receive that income up till the first 5 years or 10 years after your retirement date. And I think the government employee pension fund's 5 years. And people they still feel, but I've got this huge lump sum and it's going to the government or it's going somewhere,
Yeah.
but it's not going to my family. But it's so interesting what you're saying is actually that's often not the reality.
So what's so strange for me is that when people are prior to retirement and you have discussions with them regarding to, for instance, life insurance, they never think they will die. They always think that they plan to live. They don't plan to die. But then people get into retirement and now suddenly they start to plan to die. and one should approach your retirement to plan to live.
Yeah.
I mean, if you die, you don't have any problems. Then you don't have any financial problems because you're gone. But if you live, that's what you should plan for. But I mean, each to their own. There's individual circumstances where people's health are in such a way where they personally decide to take the risk of rather having their retirement capital as a possible inheritance, and that would be unique circumstances.
Yeah.
But in general, people should plan based on normal life expectancy.
Longevity.
And people underestimate the medical technology. They are keeping us alive, but it's costing us a lot of
Quite a
money
lot
to
more, yeah.
stay alive.
And Johann, can you do some sort of a hybrid where you take out a living annuity and a life annuity? And in which instance would you recommend that?
So in the instance where a client's got sufficient money to, for instance, have a living annuity, but have a very low drawdown rate on that living annuity, we'll have the discussion and look at their budget. And the recommendation that we'll typically make is to say, look at your necessities under your budget. So let's say take the first 50% of your budget is income that you cannot
Live without.
and buy a life annuity, lock in that guaranteed income for life. So even if you're 95 years of age and you sit in an old age home and you cannot go anywhere, at least your basic essentials are covered. And then the rest can be in a living annuity, which offers you that flexibility, because maybe for a part of your life you want to live a higher lifestyle, and then later in life you anyway going to scale down. So living annuity, the importance is a living annuity gives you that flexibility, whereas a guaranteed annuity gives you that protection against yourself, but also against the unexpected or the unforeseen future.
Yeah.
The problem is you need to have quite a lot of money to do all of this. And this is it's always so much easier to plan when you have a lot of money. I think that's, for a lot of people, they don't actually have enough money to split between it.
And keep in mind, the lower your income, the higher your effective inflation. Why do I say that? Is if you earn 10,000 Rand a month, more than half of your income will go towards your basic expenses, things like your medical scheme, your rates and taxes, your short-term insurance, a little bit of life cover, for instance. And those are expenses that you cannot do without. If you earn 50,000 Rand a month, you also have that same short-term insurance, that same medical scheme, that same rates and taxes, but you spend 20,000 Rand a month on holidays or whatever. So as you get older, you can just stop going on holiday. You can stop eating out in restaurants. So you can reduce your own inflation effectively if you earn a high income by just doing away with certain expenses. But the lower your income, the more inflation will put pressure on you, and the more important or the more relevant guaranteed solution will in all probability be. Because what I see a lot is in the living annuity space, remember, now you become the employee and the employer. So whilst you were working, your employer gave you a salary, they decided what your increase was this year, and you adapt your budget according to that. what I see with clients in retirement is they would come and say, listen, this is my new budget, and then they decide on their own increase. So if you just approach the same principles during retirement than what you had to do whilst employed, in all probability your living annuity would end up well if you started off with the correct drawdown rate.
Yeah. Now, another thing with living annuities, Johann, that I want you to really touch on is the fact that it is prone to market volatility. I remember, was it when our ex-president exed the minister, where people
finance minister, yes.
where
Because living annuities went through the floor.
really just went through quite a terrible time. Can you even protect yourself against
Market,
market
yeah, because it is
movements?
market volatility.
Yeah.
Yes, you can protect yourself against market volatility by having a proper diversified portfolio, but the time that you retire can be crucial. So if you, for instance, retire and just after your retirement the market takes a slump, then you're going to feel that for the rest of your life.
Yeah.
Whereas just the other way around as well, it might be to your benefit, but you're never going to know in advance. We've done quite a lot of presentations on retirement, and one argument that a lot of role players in the industry agree with is if a guaranteed solution can provide you with sufficient income, why do you want to take any other risk in your portfolio? Because it's somewhere you're gonna have to pay the price of taking that risk. It might work out well, but it might not. But if I tell you today, listen, if you tell me I need X amount per month, and I tell you, listen, for the rest of your life, you are guaranteed with this amount per month, why would you not want that protection? So it's a matter of people don't like the principle of giving away a form of their capital or this perceived capital, which in any way is not your capital ever, because you'll never see the capital amount, even if it goes into a living annuity. Yeah.
And it's such a difficult one to get into people's minds, this idea that, your retirement funds shouldn't be there to leave your child a legacy. They are there to make sure that you have dignity in retirement. That's actually the principle. And I've always said to people, well, if you really want to leave your child a legacy, your children, the 1/3 that you're allowed to take it, invest it, and then if you never need it, you can leave that for them, right? That's a better way to do it.
We see that a lot. We see a lot because, especially whilst guaranteed rates, like at the moment, is very good, is we see that people don't need to use their gratification or their lump sum withdrawal to supplement their pension income, because they get a good income from the guaranteed solution. And then this capital starts to build up over time. And it can either be utilized to supplement income, or it can be an inheritance.
Oh, wow. And with a living annuity, does the regulation aid rules apply, or they don't? You can invest in whatever.
This is a tricky one. They don't apply, but the
Let me just cut in there. Regulation 28
Oh, yes.
is the prudential guidelines for pension funds. So that says you have to invest a maximum of 75% in equities. You're not allowed to put 40% offshore, but it's got rules about what assets you can be invested in.
Yeah.
Yes. So the good thing is that a living annuity does not have to comply with Regulation 28, because it does not fall under the Pension Funds Act. So you can invest in underlying assets, in regulated assets, as much risk or as low risk as you want, and there's no limitations on offshore investing as well. So especially for people who plan to retire abroad but they can't take out the retirement money, they can have 100% offshore living annuity investment. What they do need to consider is the allowance that a specific platform or company has got with investors, how much they allow their investors to invest abroad, for instance. So although the product doesn't have limitations, the provider might have limitations based on their investment book.
And I want to ask, before we end off, we've spoken a lot about the retirement products. So you've got living annuities, life annuities, we've spoken about hybrid options. But you've also, Mapelo and I have been speaking in the previous podcasts about tax-free savings accounts. And I personally am going to be using my tax-free savings account as a supplement for retirement. I've got a retirement annuity because I work for myself. But I love this idea that I'm going to get a lump sum tax-free in retirement. So do you look at that in your retirement planning?
So yes, a tax-free savings definitely makes sense as part of one's retirement savings. I think the whole greatness of tax-free savings is a bit overly emphasized in the industry because it's not a magic solution towards retirement. The same as a retirement annuity or a pension fund. It doesn't mean that because of the fact that the product is called a tax-free savings or a retirement annuity or a pension fund, that it will necessarily address my needs. So what the tax-free savings does is it's a normal unit trust type of investment, but where unit trust investments are typically the gains are typically taxed, either the interest or the capital. In a tax-free savings, your gains are free of tax. So you still invest in a tax-free savings with after-tax money, but then you don't pay any tax on the proceeds of your investment. So that's the advantage of free savings. But then you need to consider, you can only invest 36,000 Rand per annum in a tax-free savings. So let's take year one. If I invest 36,000 Rand in an equity fund in a tax-free savings, even if I get huge gains, my gains will still fall below the tax threshold. So the advantage of the tax-free benefit of a tax-free savings is not over the short term. It comes much later. So I recommend clients to look at a tax-free savings almost as their resort of income when they are in their 80s, because that's by the time you will really start to build up capital, which would have been taxable, discretionary investments that would have been taxable, and now you can get this tax-free return from this. Remember, there's a lifetime limit. You're not allowed to invest more than 500,000.
Well, we're hoping that'll be lifted at some point.
Yes, unfortunately, SARS didn't change any of those legislations, but over time we see that they do make these allowances. They let it keep up with inflation.
You know, Johann is bringing such an important point because, I hosted like an investment lunch where I had this lady who was 60 and she was saying, should I be looking into a tax-free savings account, right? And he's saying, effectively, you can still invest in one at the age of 60 and say, when I'm 80, we'll have these funds that I can try to supplement my income. Because normally people who are close to retirement, they're thinking to themselves, I'm late. I don't have enough time anymore. But to say, okay, whatever you've accumulated in your pension or provident fund, fantastic, or retirement annuity, but you can still invest in this thing, because the assumption is, instead of thinking that you're not going to make it to 90, what if you do?
So for my mom, and I've done a few podcasts about tax-free savings accounts and how they shouldn't be put in cash-like investments, right, in interest, unless you are in retirement. So we use my mom's to lower her interest rate, the tax, because when you're in retirement, you often have a lot of cash investments, and she then is now every year she puts her 36,000, so she can start building up and getting interest income from there that's not taxable. So yes, it becomes a very different instrument in retirement.
And you can utilize, and that's the same principle applies to all financial products. You shouldn't look at the product in isolation. You should look at it as a tool, as part of your whole toolbox of solutions, and utilize it, because if you utilize it cleverly during retirement, you can do it quite effectively.
Wow, brilliant. Johann, I think we could keep you here for hours, but I think we're going to have to wind it up. Otherwise, our poor listeners will be, wondering when this will come to an end. But I think that's been really, really interesting, Mapelo.
Yeah, it has been. I mean, we love talking about personal finance, and hearing it from good financial planners' perspective, it has been completely refreshing.
And I do have to say, and I hope that the listeners have really gained understanding from Johann, because we always say go get financial advice, but unfortunately, Johann, not all financial advisors are equal, and it's great to have a certified financial planner like yourself on this podcast.
It has been completely refreshing. And I think for me also, outside of the fact that, we're talking about retirement, this is what good financial planning should look like. When you're sitting in front of a financial planner, your mind should just like sparks. That's what you want. And for me, that's what this has done for me. Like, what? Good financial advice still exists.
Absolutely. So thank you, Johann.
Thank you, ladies. Appreciate it.